It's been a busy day for you. Was this all about the CPI numbers today?
Yeah, thanks very much, Sherry. Yeah, it really was. When we saw that CPI number come out, my first thought was, if you're a Fed official or somebody who's looking for inflation to slow down over the course of this year, this was exactly what you did not want to see. You really saw inflation that it's not only strong in the goods component where it has been strong, but also strong in shelter, with shelter prices actually accelerating, at least in the direct rents. And then you look at other services, and that's where, we think wage pressure is starting to bubble up, starting to come through. So all of a sudden, it's just looking like there's a lot more momentum behind these higher inflation readings that can continue. And I think that's what President Bullard is reacting to.
So you're now expecting 50 basis points in March and then 4 25 basis point hikes in May, June, September, and December. How much will that help with these inflationary pressures?
So I think that's the real issue that the Fed is facing here. And I think that's part of the urgency that you're starting to hear from some Fed officials, which is when you're overshooting the 2% target by the amount that we are, and you think about raising rates 100 basis points, 100 basis points sounds like a lot of rate rise. But remember, we have inflation that's running 6%, 7%, depending on how you measure it. So you're something like 400 basis points above target. So the idea that you would have, nominal rates at something like 100 basis points, you subtract that inflation rate from that to get back to the real rate. So you still have very negative real rates. So getting rates up to something like 100 basis points relatively quickly, I think it makes a lot of sense in this scenario. Gives the Fed more options for where you move, because you're really still not moving into restrictive territory until you get significantly higher from there. So I don't know that it has a lot of effect in terms of bringing inflation down, but at least it's moving in the direction of where you might have some effect.
What is the urgency and timing that would make it have the best chance of being effective, given we know the lag when it comes to transmission, right? Should we be talking about the idea of, not having to stick to the program when it comes to timing of making rate moves?
Yeah, so I think to the Fed's credit, we've heard them talk about being flexible, being nimble, and we're starting to see them do that to some extent. So, if you looked at where we were 3 months ago, 6 months ago, a year ago, there was a large edifice that you had to get through to actually get to rate hikes, right? There were all of these hurdles that you had to get over in terms of ending asset purchases. And all of those things have happened faster than we had expected, than I think many in the market had expected, and certainly faster than what the Fed had expected. So here we are sitting at the very beginning of 2022. We're contemplating a rate rise in March. And maybe a larger rate rise in March. And I would say, base case is this 150 basis points of hikes over the course of 2022. But with the amount of inflation overshoot that we have, and we're forecasting, if you go out to the end of 2022, we think we're still running at least 3.5% core PCE inflation, even as we end the year. That would imply to me that, if anything, there's even further upside risk. Could they move 50 basis points in March and 50 basis points again in May and be at 100 basis points in May? It's not my base case, but it could happen.
Given the dislocations from the pandemic, the unusual, nature of the economic recovery that we're seeing at the moment, how do we approach the flattening of the yield curve? Does it portend doom and gloom and recessionary conditions necessarily?
I think you always worry when you see a flattening of the yield curve. And part of what the flattening of the yield curve is showing you actually is that markets still have a belief that the Fed will act to get inflation down. It's not that we have market implied inflation expectations that are very elevated if you look out at those far forward rates. So to some extent, it's an endorsement that the Fed will do what it takes to take out these higher inflation scenarios. But on the other hand, if you think about what really brings down inflation, it's slowing down the economy. So what the Fed would like to achieve is a soft landing where they move rates up gradually, that slows the economy down, that brings inflation back to target. But you have to build in a probability, and I think it's a growing probability of scenarios where inflation stays higher, the Fed has to act more aggressively. And it may be that the best case scenario is that you end up with a mild recession. I don't think that's a scenario that anybody wants to see happening. It's certainly not what the Fed is trying to engineer. But given that inflation is significantly overshooting, that probability is out there now.
Exactly, because we, of course, have seen the world's most aggressive tightening campaign coming from Brazil. I understand that there are very different economies, different political backdrops, but we're seeing the economic impact already, falling into a recession, households really choking with debt, markets not doing great, and inflation really not slowing significantly. What are some of the things that the Fed should watch out for right now?
So I think what the Fed wants to watch out for in the inflation data is, are we getting further momentum between prices and wages? And I think you can look at the data now and you can basically say, whether you look on a year-on-year basis or look at a monthly annualized basis, we're running somewhere between 4 and 7% annualized wage inflation and price inflation. So clearly both of these metrics are above the target level of around 2%. So what you want to avoid now is further momentum where workers are seeing higher prices, then they ask for higher wages, and then firms are seeing higher wages, so they have to raise prices further. And so I'm really looking at a lot of the anecdotal data, what we're seeing in the Fed Beige Book, what we're hearing from corporates in their earnings calls. Are they talking about further wage rises, further price rises, and passing those costs through to the broader economy? And we are hearing that right now. So I think, again, another reason that the Fed should be looking at the constellation of data as well as these anecdotes and saying, yes, there's still the potential for inflation to slow over the course of the year. But I think relative to maybe what the assessment was a few months ago, you should be a lot more concerned now about higher inflation through the rest of the year.